Hi friends, welcome to the channel JAIIB and CAIIB Made Simple. So this is our unit number 10 of CCP and the chapter name is Non-Financial Risk Analysis and Macroeconomic Factor. So these are the topic we are going to discuss: objective, introduction, characteristics of non-financial risk, how to mitigate the non-financial risk, what is the impact of macroeconomic factor on NFR, and dealing with recoveries. So let's get started with our very first concept, which is financial risk versus non-financial risk. Let's understand the basics. What's the difference? So we are starting with a non-financial risk, also called NFR. In short, we will call NFR. In simple word, these are the risks that do not come from loan, market, or liquidity problem. Instead, they come from people, process, technology, compliance, external disruption. Right? So basically, we are talking about those kind of risk which do not arise from market, credit, and liquidity. Rather, they arise from where? They arise from people. Right? They arise from process, people, process, technology, compliance, and external disruption. So the first concept we have is the financial versus non-financial risk. Let's understand the difference. Financial risk are traditional banking risk, like it may be credit risk, like the loan not paid. It may be market risk, like investment value change. It may be liquidity risk, like shortage of cash. Banks were mainly worried about these earlier, but today banking has changed a lot. Now we have mobile banking, digital payment, cyber attack, third party vendor, heavy compliance requirement, right? So earlier, banks were worried about this kind of credit, market, and liquidity risk, but today banking has changed. We have mobile, digital payment, cyber attack, third party vendor, heavy compliance requirement. So new type of risk have become more important, and those risks are called non-financial risk. So the quick rule is that NFR is equal to all the risk except market plus credit plus liquidity. Suppose if a cyber attack shut down a bank app, that is called non-financial risk. Now friends, what are non-financial risk? So these are the risk which when something goes wrong in compliance. Compliance means rules not followed. Then conduct means employee behavior issue. Then technology system failure, it. Operational lapse, like process mistake. Models, suppose some models disruption is there, like wrong model output. Strategy means wrong business decision. And third party vendor, that is called outsourced service fail. So these risks don't directly hit profit like credit or market loss. They don't directly hit the profit, but they can cause huge damage to a bank reputation, right? They can cause huge damage to the bank reputation, business continuity, right? And customer trust and long-term strategy. So the NFR formula is operational risk, cyber risk, conduct, model, compliance, strategy, and third party risk. For example, suppose a bank app stop working after an upgrade. So that is a technology or operational NFR. So the master tip is that NFR is everything non-traditional but highly destructive. Everything that is non-traditional but highly destructive, that is called NFR. So what we should focus on? We should focus on compliance, technology, and conduct event, because these cause maximum damage in the modern banking. These things cause maximum damage in what? In modern banking. So the formula flashcard is in front of you. Remember, NFR means total risk minus credit plus market plus liquidity. And operational risk is the 7 Basel event. I think this 7 Basel event, right? Including fraud, system failure, process error, etc. So this is the easy way to remember it. Now let's apply the concept to some MCQs. First question: NFR exclude which set of risk? Compliance, model, cyber, technology, conduct, strategic, market, credit, liquidity, third party, operational. So yes, it exclude market, credit, and liquidity, right? So these are the financial risk. Everything else fall under NFR. Next question: digital disruption and increased dependency on technology mainly increase which risk? So suppose digital disruption is there and we are increasing dependency on technology. It mainly increase which risk? Market, technology, operational, liquidity, interest. Correct answer is B. It increases the technology and operational NFR. Why? Because it is very simple to understand. If you have more digital banking, right? More digital banking, it means more dependence on digital technology, right? More dependence on technology, and more dependence on technology, it means higher take and operational risk. Risk increases because you are doing more and more digital banking, so more dependence on technology, so technological and operational risk increases. Very simple logic. Now let's have a look at the next concept: NFR versus operational risk. Very important. So operational risk is actually a part of the NFR, right? Operational risk is a part of NFR, but the NFR is bigger. It covers many more risks that are not included in the official definition of the operational risk. So operational risk is a part of the NFR. You can think of it like this. Suppose this is your op risk. So this is your NFR. So you can see just a subset of NFR. So operational risk include what, let me show you. So operational risk include process failure, right? Process failure is there in operational risk. System failure, human error, internal fraud, right? Internal fraud and external fraud. But NFR also includes some additional risk like a strategic risk. You know what is a strategic risk? So when I say a strategic risk, it means that whenever a bank make a wrong business decision, so they have not taken the proper decision, that's called a strategic risk. What is reputation risk? So when a bank image is damaged due to public reaction. So and beside that, there are some other leftover non-financial risk also. So the key understanding is that all operational risk is NFR, but all NFR are not operational risk. Very, very important. Think of it like this. Operational risk is one chapter in the big NFR book. Suppose we have an NFR book. Inside this one chapter is the operational risk. For example, let's suppose if a bank suffer a social media backlash that damages its public reputation. So this is basically what we call NFR, but it is not counted in operational risk, right? Suppose there is a reputational damage from the social media backlash. So it is NFR, but you cannot count it under operational risk. So I hope the difference between operational risk and NFR is crystal clear. Friends, for your information, let me tell you that the content you are watching is a part of our CCP mentorship program or comprehensive plan, which help you provide PDF, videos, mock test for the entire CCP syllabus, completely prepared from Taxman reference book. In addition to that, we provide you previous year question only. If you want to get access to those content, in which if you go through the content for each and every at least one time, everything will be crystal clear. You can WhatsApp me on this particular number. Now friends, let's look at the next concept, nature of NFR. Why NFR is a pure loss? We will answer the question, why NFR is a pure loss. NFR is very different from financial risk. Financial risk, like market risk or credit risk, it has both upside and downside potential, right? It has both upside and profit potential and downside potential, right? But so for example, a bank might take a market position and earn profit, or it may lose. But non-financial risks are different. They offer no upside at all. You cannot find any upside in that. You will always find downside only. That is the point. If something goes wrong, the bank faces only loss. That's it. So the formula view is like this. Financial risk, obviously it is a risk. Chance of profit is there. But non-financial risk, you are taking risk, pure loss probability. For example, suppose a staff misconduct leads to penalty from RBI. The bank only loses money. There is no possibility of gaining anything from that risk, right? So the master tip is that NFR don't have any upside risk, only potential loss, zero revenue. So the formula flashcard you can see, operational risk is a subset of NFR, subset relationship. NFR include operational risk plus strategic risk. A strategy because of any kind of risk that bank is exposed to because of wrong decision it has taken. Reputation risk we have just discussed. Other non-financial risks are there. I hope this is crystal clear. Let's apply the concept to some MCQs. Question number 1. Which risk category has no upside unlike financial risk? The option they have given: market, liquidity, non-financial, credit. The correct answer is non-financial. Just now I have given you one example, right, which clearly shows that non-financial risk has no upside. For example, I have given you, suppose there is a bank, right, and bank the staff misconduct lead to penalty from RBI. So is there any gain for the bank? Bank have to pay the penalty only. There is no possibility of gaining anything from that risk. So that's why it has no upside risk. It has no upside potential. It has only downside potential. NFR we are talking about. Next question. Which statement is correct? All NFR are operational risk? No, wrong. Operational risk exclude compliance issue. All operational risk are part of NFR? Exactly. C number is correct. Now let's look at the next concept. That is the characteristics of non-financial risk. So this is a very important concept that we are talking about. Let's start with important idea. NFR work with like a triangle. There is an NFR management triangle. For a bank to manage non-financial risk effectively, it must balance three things. Customer aspiration or customer expectation, which means customer want what? Customer wants safe, reliable, honest service. That is what customer want. Then regulatory expectation of the regulator, which means a regulator and RBI and other regulator, they want strict compliance, strict following the law. right? So NFR management depends on the triangular balance of these things. And the third thing is expectation of shareholder. So shareholder means owner. Owner means owner want a stable profit. He want profit to be stable throughout the year and zero scandal. That is what owner want or investor want, right? So if even one side of the triangle is ignored, NFR management become weak. So we have to, this is a triangular balance of the customer who wants safe, reliable and honest service, a regulator who want a strict compliance, shareholder who want a stable profit. If so, this is a triangle, right? And if any of the corner or if any of the side of the triangle is ignored, then NFR management become weak. So the formula or rule is that, effective NFR, it is equal to customer trust plus regulatory compliance plus shareholder confidence. Suppose, for example, if a bank failed to meet the regulatory expectation, it may face penalty. It become an NFR event, right? Shareholder become unhappy. So if any pillar, if any side of the triangle faces is ignored, NFR management become weak. Why? In this case, they have ignored this regulatory expectation. They ignored this compliance part. So RBI impose penalty, and obviously NFR accident may happen. So shareholder become unhappy. Now let's talk about the connection between financial risk and NFR. Many people think that financial risk and non-financial risk are separate, but in reality, financial risk and non-financial risk, they are connected. In reality, they are connected. A financial risk can also create an NFR. Very important thing I'm telling you about. Even financial risk can generate NFR, and even NFR can cause financial loss. So both are reciprocating in nature. They can trigger each other. For example, a credit default may damage a bank reputation, and you think about it. Suppose there is a credit damage, right? Credit default happen. Think about it. Suppose credit default happen and credit default damage a bank reputation, and this reputation damage is a kind of non-financial risk, isn't it? Suppose cyber attack happen. So cyber attack is a kind of NFR, right? This is not a financial risk. So this cyber attack, it may shut down service. It may lead to financial loss. So you can see now both are correlated. FR can lead to NFR. NFR can lead to FR. Simple formula is that, NFR, reputational damage, financial loss. Financial risk may create NFR event. So both risks are interlinked. They are not isolated, right? The next concept we have is the impact of NFR on bank reputation and employee. So whenever an NFR event happen, the first thing that get hit is the bank reputation. It leads to reputational damage. It affects customer trust, customer confidence, regulator trust, shareholder faith, and employee morale. Employee get stressed due to investigation, audit, accountability pressure, right? That's why they get stressed. So the simple formula is any NFR incident, reputational damage, pressure on employee, investigation, accountability. Suppose a bank violate a compliance rule. Investigation begin, employee face question, reputation suffer. So the master tip is that most NFR event hit reputation first and finance next. So NFR, reputation, and then financial loss. So let's have a look at the formula flashcard. The first formula is NFR and financial risk are interlinked, not exclusive. Second thing, NFR event sometimes trigger regulatory pressure, employee stress, customer confidence loss. Third thing is, so I hope this is clear. Let's apply the concept to some MCQs. Which three expectations form the basis of NFR management? So which expectation form the basis of NFR management? Shareholder, employee, vendor, customer, regulator, shareholder, regulator, competitor, employee, customer, management, media. Just now I told you about customer, regulator, shareholder. These are the three pillars or three corners, three sides of the triangles. What is the usual first impact of NFR event? Profit increase, share value jump, reputation damage, reduce workload for employee. So the first impact for NFR is your reputational damage, right? Just now we have discussed. See, so friends, the first concept is, no matter how strong your system are, NFR can never be eliminated. It is unpredictable. You cannot eliminate it. Bank can upgrade their SOP. Bank can train their staff. Bank can strengthen the internal control. But NFR is still unpredictable. Fraud, misconduct, cyber incident, customer complaint, they can happen anytime. So the key idea is that the only predictable thing about NFR is that it occur unpredictably. The only thing about NFR is predictable, that it occur unpredictably. Formula is that high investment is not lower NFR risk. You can spend crore and still face an NFR event, right? So for example, even after implementing advanced SOP, standard operating procedure, a sudden fraud can still pop up, right? So conflict between front office and back office. Inside every bank, the different teams have different priority. Like, front office, that's called sales, right? Front office are like, sales. So they want speed, quick approval, customer convenience. Then we have the back office. So back office, they want operations, right? Basically, they want accuracy, they want proper documentation. So, and then, compliance. So basically compliance want strict check and zero violation. Risk team want full control and monitoring. So their priorities often conflict, and that is exactly where NFR grows. So everyone has different priority. They have priority different. They have priority different. Operation have different priority. Risk management have different priority. So because of this conflicting priority, the NFR grows. So the rule is that, contradicting rule, control gap, NFR growth. For example, sales want speed. Sales want to approve loan quickly. Compliance insist on full KYC checking. So this clash create pressure and it increase the NFR risk. Now business versus compliance priority. One of the biggest challenge in NFR management is balancing. Balancing what? Bank must balance business goal with compliance requirement. So too much business focus create uncontrolled risk, and too much compliance focus kill business growth. So that's why the correct approach is business with compliance. Formula is that business without compliance, this will cause NFR disaster. Compliance without business will cause not sustainable, not viable. So the example I can give you, suppose a bank approve loan fast but ignore proper KYC. So it means NFR explosion. So the master tip is that the safest rule, business growth with compliance, not against it, not without it. I hope it is crystal clear. So the formula flashcard is, contradiction between department occur mainly because of high NFR probability, right? This causes, there is the chance of high NFR probability because of that. So safe zone is balance business priority and compliance discipline. If you balance both of them, it is a safe zone, right? So that is the point. So now let's do some MCQs. So what is the only prediction that can make perfect about that can be made perfectly about NFR? It is stable, no. Fully controllable, no. It happen unpredictably, yes. Next question. What should be the priority for the bank according to the passage? Business first, compliance later. See, I told you that business plus compliance, NFR decreases. If you have a balance, then NFR decreases, right? So business first and compliance later, no. Compliance first, business optional, no. Both are equally unimportant, no. Correct answer is business with compliance. Yes, D is the correct answer. There should be a balance between both of them, right? That is the point. This is the safest and most sustainable risk approach. Now, mitigating NFR. How do we mitigate the NFR? Let's have a look. The first thing to understand about NFR is that, no matter how much a bank invests in staff, system, SOP, NFR can never be eliminated completely. So bank, what they can do? The bank can upgrade the process, strengthen their team, digitalize operation, improve control, but still NFR can appear suddenly and unexpected. Now, the next concept we have is a harmonized structure, right? Let's talk about the harmonized structure. Very important topic we are going to discuss right now. Yes. So what is the objective of an NFR management? See, a good NFR management system in a bank should focus on three main goals. What are the three main goals? First of all, prevent malfunction, which means stop fraud, error, system glitches, compliance gap. Second thing is, see, first core objective they have mentioned, stop malfunction. Any kind of fraud, error, system glitches, compliance gap should be stopped. Then they have to meet the stakeholder expectation, which means customer, regulator, shareholder, their expectation must be made. Third is to reduce unnecessary cost, because NFR incidents are expensive. That's why reducing cost is very important. So the simple formula is, for effective NFR, we have prevention, responsibility, and cost control, right? For example, better control, fewer operational error, lower cost. If we have better control, see, suppose our control increases, better control, then what happen? Error will be less, and since error will be less, so cost will be less. So that is how these three things should be done: reduce the cost, meet a stakeholder expectation, and prevent malfunction and risk. So these are the three core objectives of NFR, effective NFR, right? So now, for example, I can give you, like suppose better cost, fewer operational error, and lower cost. So the three vital element of NFR framework. A complete robust NFR framework is built on three pillars. First one is the harmonized structure, which means all departments are aligned. When I say harmonized structure, it means, all departments are aligned and all departments are coordinated. That is called, harmonized structure. facilitating factor, like technology, policies, right, reporting system, and culture. So these are called facilitating factor. And paradigm shift in staff outlook. Employee must think with compliance awareness. Employee, they must think with compliance awareness. Simply installing system is not enough. If employee mindset do not evolve, NFR stays high. So there should be a staff change in the staff outlook also, right? Formula is that robust NFR, it means structure, support factor, staff mindset change, right? For example, suppose a team with the right compliance mindset automatically reduces the NFR event. Suppose there is a team and this team has a right compliance mindset. It reduces the NFR event. So now we have the 3-circle or 3-line defense model. Very, very important. See, globally, bank use the 3-circle or 3-line of defense model to control the NFR. That's called 3-circle insulation for NFR management. The first circle is called, front line. So that's called front. You can call it front line, or you can call it, business unit. So what happened here, they own and manage the risk, which means this is the first and most important barrier. They handle the customer interaction, right? They handle onboarding, KYC, documentation. That's called front line. That's called business unit. Then we have the control. Second circle is control. That is risk and compliance. So they ensure that everyone follow the rule, policies, standards, and if any gap which is missed by circle 1, that is detected in circle number 2. And circle number 3 is the audit and inspection. That is the final layer of defense. So independently check whether circle 1 and circle 2 are functioning properly. That is checked by circle number 3. So the formula is that 3 circle we have: first line business, second line control, third line audit. So this is called first line of defense, second line of defense, third line of defense. So suppose front line staff fail, then control detect, control fail, audit verify. Suppose front line staff misses a KYC lapse, then control detect it, and then audit verifies it. So the front office as a primary defense. Among the 3 circles, the front office is the first and the strongest shield. Why? Because most NFR incident start at the front line, especially customer onboarding. Most of the NFR incident happen here, right? Customer onboarding, KYC, document handling, and transaction. If circle 1 is strong, other circle don't have to work under pressure. More vigilance at circle 1, less NFR overall. For example, if KYC is incomplete at front line, the issue become major NFR event later. So the master tip is that front office is the first shield. If circle 1 fail, NFR slips through all the layers. So what is the formula flashcard? NFR framework means harmonized structure plus facilitating factor plus staff mindset shift. 3 line of defense: front line, control, and audit. Right? Front line FCA, front line, control, and audit. This way you can remember. Now question is, which circle in the NFR management model own and manage the risk? Own and manage the risk. Option they have given: audit circle, control standard circle, front line circle, technology wing. The correct answer is front line circle, because they directly handle the customer and they execute transaction, so they own the risk. Next question: which of the following is not one of the 3 vital elements of NFR management methodology? Harmonized structure, facilitating factor, paradigm shift in staff outlook, business growth target. This is one. Harmonized structure is other. Business growth target is not. Facilitating factor is one. So these are the elements. So friends, that's all for the free portion. The remaining portion will be available in our courses. You can get more detail regarding the